Okay, we're going to look at Chapter 12 homework, exercise 12:18. And on this one, this is really kind of a review. We are purchasing equipment for $450,000, and we're issuing a note payable. It's a 15-year, 14%. The note payable will be for the amount of equipment, and we're going to pay it in installments. So each year we're going to pay $30,000 of the note plus the interest. So we purchased equipment by using the note. Now, to accrue interest, we purchased this in July. So we have July, August, September, October, November, December. So 6 months. So we're going to take the amount, the principal amount of the note, which was $450,000. We're going to times it by the 14%, 0.14, and then it's 6 times 6 out of 12 months, or 1/2, or 0.5. So when you do that, your interest is going to be $31,500, and we're only accruing it. We're not paying it yet. So this is to recognize the interest. Now, when we pay the first installment on the note, we're going to pay the part of the note payable. Now, it is a $450,000 note, and we're going to pay annual installments of $30,000. So $30,000 on the note, plus we have interest. We have the interest that we already owe from the first 6 months, which was $31,500. And then we have interest expense for the other half of the year, which should be the same $31,500 because it's split straight down the middle. So we're going to pay cash of $63,000 of interest plus 30 should be $93,000. And this is to pay the first installment of the note. Now, to accrue the interest on the note payable for the next year, well, first of all, our principal is not $450,000 anymore. We just paid $30,000 of that. So we're only going to calculate interest on $450,000 minus 30, which would be $420,000. So we're going to do $420,000 times 0.14 times 6 out of 12 months, 6 divided by 12. So our interest we're going to accrue is going to be $29,400. And this is to pay, to recognize accrued interest. The total liabilities that we have as of December 31st, 2019, well, we have $420,000 left that we owe on the note, plus the $29,400 of the interest payable. So 420 plus 29,400 would be $449,400. Now for this next question, we're issuing a bond. So as you can see, our bond is only going to be issued at 98, so it's going to be issued below the face value. So we're going to get a little bit less in cash than what the face value is. So if you do 130,000 times 0.98, we're issuing this at a discount. So we're only going to get 127,400 cash, but we're going to actually pay back the full 130,000. So this person who's giving us their cash, they're getting a discount. and the discount would be the difference between 130,000 and 127,400. So the discount is 2,600. Remember, discount has a debit balance. So this is to issue the bonds at a discount. Now, to journalize the semi-annual interest payment and amortization of the bond discount, the first thing we're going to do is we're going to debit interest expense and we're going to credit cash, but we're also going to reduce the amount of the discount. So we normally debit it, so we're going to credit it when we amortize the discount. So to calculate the cash payment, you take the principal, which is the face value of 130,000, times the rate, which is your percentage here, the 5%, the stated rate, times the time. And this is semi-annual, so that's every 6 months, so 6 divided by 12. So we're going to pay $32.50 in cash. Now, we're going to credit the discount. To amortize the discount, you take the total amount of the discount, which is $2,600, and you're going to divide it by the number of interest payments. The number of interest payments is going to be, it's a 20-year bond and we're paying semi-annually, so twice a year. So there's 40 interest payments. So take 2,600 and divide that by 40, and we're going to amortize the discount $65 each payment. So to get the interest expense, it's just a plug number. Add these two together, the amount of the interest payment plus the discount amortized, and our interest expense would be $33.15. And this is to pay semi-annual interest and amortize the discount. Now, for the next question, this is similar, but this time we're going to issue the bond at 102%. So we're issuing the bond at a higher amount, which means we're going to get more cash. We're receiving a premium. So you do the face value of 180,000 times 1.02, and you will get 183,600. But we're only going to pay back $180,000, so we're getting a premium on the bond of $3,600. So this is issuing a bond at a premium. Now, to journalize the interest payment, this is semi-annual also. So this is 6 months. So remember, we're going to amortize, we're going to debit, first of all, interest expense, and we're going to credit cash. Now, we're amortizing a premium, so we normally credit a premium, but to amortize it, we're going to debit it. Now, first, let's start with cash. We do principal times rate times time. So 180,000 is the face value. Always use the face value to calculate the interest payment. Times 0.10 times 6 out of 12. So the cash is going to be 9,000. Now the premium, we have a 20-year bond, semi-annual, so there's 40 interest payments. So take 3,600, divide it by 40, and we're going to amortize the premium for $90. So interest expense here is a plug figure, but when you're doing it here, you're going to take the difference. 9,000 minus 90 would be 89.10. And this is to pay the semi-annual interest and amortize the premium. Now, to journalize the semi-annual interest payment again, well, it's going to be exactly the same thing. Interest expense, when you use straight line, your entries are going to be the same every time. That's the benefit of using straight line. Just like in depreciation, when we do straight line, it's the exact same amount every single time. And then this is to pay your interest and amortize the premium. And then we're going to retire the bond in 20 years. 20 years would be the end of December 2037, almost January 1st, 2038. So all we're going to do is, we've already recorded all the interest. So all the interest has been paid. All we're going to do is look at the bond payable. It was $180,000, so we're going to always pay back the face amount no matter what we issued it at. This will be your entry at the end to retire the bonds payable. Now for this question, this is a serial bond, and we borrowed $990,000, and we're going to pay in 3 equal installments. So 990 divided by 3 is 330. So we're going to have 330 that we're going to pay within this year coming up. So the rest of it is going to be in long term, and the one that we're going to pay in January in less than a year is going to be in current. Now the interest, take the principal right now is $990,000 times the rate, which is 0.15, times the time, which is a year. So our interest is $148,500. Now for the next year, we only have $660 left. $330 is going to go in current, and the remaining $330 is going to go in long term. To calculate the interest, calculated on the $660. So 660 times 0.15 times 1 would be $99,000. Now we only owe $330,000, and that's all going to be current. And then we're not going to have any in long term because we're paying it all. We have to calculate the interest on that 330. So 330 times 0.15 times 1, and that would give me $49,500 for interest.